Hi everyone, welcome to the third video in the Stop Trading online video course for our VIP members. We've already talked about what Forex is and how it's possible to make money trading Forex. In this video I want to talk about the reasons behind why Forex prices actually move up and down, enabling traders to capitalize on price movement to make money. Okay, let's get started. Now, Forex prices are constantly changing, but why do these prices move in the first place? Well, there are of course a number of reasons for this, but let's begin to discuss the three types of analysis that a Forex trader would apply when trying to identify these reasons. The three types of analysis are as follows: fundamentals, sentiment, technicals. Let's take a closer look at each one of these. First of all, we have fundamentals. Fundamental analysis is a method of evaluating the value of a currency pair based on external events and influences. Some examples of fundamentals include economics, so things like a country's interest rates, employment figures, the housing market, etc. Next we have politics. Politics can have a significant impact on the value of a currency. You only need to look at the situation the UK experienced with Brexit to see the impact on the pound. A changing of government or a political shift can also have a huge impact on a currency. Finally, we have news. News can have a tremendous impact on currencies. We live in a world nowadays where major breaking news stories can quickly cover the globe within minutes via the internet and social media, and this often has an immediate impact on currency value. Currency prices can even rise or fall based on the tweets that US President Trump fires off from his Twitter account. Next we'll talk about sentiment. Sentimental analysis is based upon opinions for how the markets are playing out. For example, some Forex traders may feel that a complete change of government will be a good thing, so may be planning to go long on a particular currency over the coming weeks. However, others may feel that a change of government represents a significant risk to a country's economy, so may in fact be planning to go short on a currency. Remember, not all Forex traders will think the same way. Now you have to bear in mind that ultimately it doesn't really matter what you personally think, because as a small home-based retail trader, you will have almost zero influence on the direction of a currency pair in a $1 trillion market. The important thing is if you can gauge what the big investors think will happen. They are the guys who have the financial clout to move markets. You should never try to trade against them. It's completely foolhardy. Even if you're convinced that it would make sense for a currency pair to go in one direction, if the big players are going in the opposite direction, well then you should be looking to change your directional position very quickly. The question you should be asking yourself is, should you be going long when the rest of the market is going short? The last form of analysis I want to talk about is technical analysis. Generally speaking, Forex prices tend to zigzag up and down, as the graph depicting the price of the pound to the dollar illustrates. Now as these prices zigzag along, you will see that they tend to be either trending in an upwards or downwards direction, or they're ranging sideways. Here you can see an example of a price trending upwards, compared to a price that's generally ranging sideways. Now if you open up any Forex chart and look along its timeline, you'll see periods when the price has experienced both trending and ranging periods. Now if you're completely new to Forex trading, Forex charts can seem almost random in direction. They go up and down and then up and sideways and down and up. Well, you get the picture. Fortunately, as you start to grow more comfortable with trading Forex, you will slowly start to see and identify patterns repeating, and you'll get a feel for the price action and how it moves. More often than not, prices do tend to oscillate or bounce between 2 points. These points are known as trend lines, and you tend to have an upper trend line and a lower trend line. Now you have trend lines in both trending and ranging markets. The upper trend line is known as the resistance line. The line is resisting the price from going further up, so the price tends to bounce off this resistance line and starts to head back down again. Similarly, the lower trend line is known as the support line, and it tends to support the price from dropping further down. You'll often find that as a price heads downwards, it will bounce off a support line and start to head back up again. Here is an example of a pair of trend lines in a trending market, which is often referred to as a trend channel. You can see that as the price of the currency is trending upwards, it tends to bounce off the upper resistance line and head down, before hitting the lower support line and heading back up again. Now, in terms of identifying where areas of support and resistance actually are from a price perspective, one thing to note is that the price often tends to bounce when it reaches a whole number, such as 1.20000. So for example, if the price was heading down from say 1.20125 and getting closer and closer to 1.20000, then you'd certainly want to pay attention as the price gets to this whole number, because there is often a good chance that the price will find support. The same applies to when a price is heading upwards. So it may be at 1.19925 and heading upwards, and there's a chance that it could reverse and head back downwards as it reaches 1.20000. So before we move on, let's just stop to think about why this would happen. Why does a price often reverse at whole numbers? The reason is what's known as a self-fulfilling prophecy. A self-fulfilling prophecy is basically when enough people believe something will happen and act accordingly on that belief, so that the combined belief actually influences the outcome. So basically, if enough people place a trade for the price to reverse at a whole number, then the price can actually change at that whole number. Another example of a self-fulfilling prophecy in Forex trading is the Fibonacci retracement. Now, we do have a separate video as part of our online trading course, which is specifically dedicated to Fibonacci, as it forms part of the overall trading strategy that we use here at Stop Trading. So I'd recommend watching that video for a good understanding of what it is and how it's applied to Forex. More examples of self-fulfilling prophecies are the trading indicators that hundreds of thousands of Forex traders all around the world use every single day, such as simple and exponential moving averages, moving average convergence divergence, and relative strength index. I do appreciate that some of these terms may seem completely foreign to some at this early stage of their Forex trading career. However, we will cover all of these types of trading indicators in a separate video. More examples of self-fulfilling prophecies are 3 candlestick patterns, which are essentially groups of 3 sequential Japanese candlesticks on a chart. Another example are triangle chart patterns. Once again, all of these things will be explained in far greater detail as you move further into our online course. Now, whether you believe in them or not, you still need to be aware of and understand the most common self-fulfilling prophecies, simply because there are so many other traders out there who focus on them. Now, whilst they can be very powerful, they are of course not infallible. Just going back to the example of prices often finding support and resistance at whole numbers, it doesn't necessarily mean that they always will. This is why you should look for price confirmation before placing a trade, which is something we will cover in greater detail in later videos, and is so important to trading successfully. One thing you definitely want to avoid as you progress with your Forex trading career is what's known as curve fitting. Curve fitting in Forex terms is when you essentially convince yourself that something should happen because it's happened in the past and therefore history should repeat itself. Now, in the case of Forex, price action does often repeat itself, but that's not always the case. Be very careful about placing trades in this way. Some Forex traders develop strategies for entry and exit on a trade, and they develop this strategy based around the historical price action of a currency pair. Doing this is akin to firing shots into a window and then drawing bullseyes around each bullet hole afterwards to suggest that you are perfectly accurate with every shot. Like I say, you should always be very careful not to do this. Okay, so rounding up, which driver of price is the most powerful? Well, we believe that during periods of global and economic stability, Technicals and fundamentals tend to drive prices. During these periods, there is no strong compelling reason for prices to move in any particular direction. Therefore, things like market economic updates from individual countries, combined with things like technical indicators such as moving averages, well, they can drive price movement. However, during periods of global instability, and I should quickly point out that the world is experiencing an unprecedented period of instability like no other right now with the current global coronavirus pandemic, well, during these periods, technicals and to an extent fundamentals are completely ignored, and the market sentiment is the supreme driver of price. If people have worries about a currency, they really don't care about support and resistance lines. They don't care about whole numbers, they don't care about things like triangle patterns. They just feel that the market is going to tank, and that's all there is to it. The one thing you should take from this is that trading Forex during a stable period is entirely different to trading during an unstable period. So you need to factor this into your trading approach. And we do of course cover trading outside of stable periods in later videos. Okay, well I hope you've enjoyed this video and thank you for watching.